Welcome back to the Deep Dive. Today, we're plunging into a topic that's, well, it's everywhere, blockchain. It promises so much change.
It really does.
And look, you don't need to be a tech wizard or a finance guru to follow along. We're here to guide you through it.
Absolutely. Our mission today, let's demystify blockchain. We want to cut through the jargon, focus on what really matters so you can get a solid grasp of this, frankly, transformative technology.
Okay.
And yeah, we'll talk about Bitcoin, obviously. It's a key example.
Sure, you kind of have to.
Right. But the main focus, it's the underlying blockchain tech itself, not just its most famous app.
Okay, perfect. So let's just dive right in then. Let's unpack this. What exactly is blockchain? We hear the term constantly, but what does it actually do?
Right. Well, at its core, blockchain is a type of software. Think of it as a foundational digital protocol.
A protocol, like for email or the web.
Exactly like that. It's designed specifically for securely transferring unique bits of value, things like, well, digital money, obviously, but also property titles, contracts, maybe even your identity credentials.
Right. Directly over the internet. And here's the revolutionary bit.
Mm.
It does this without needing a middleman. No bank, no government, no central authority needed for the transfer itself.
Wow. Okay. So no middleman for sending valuable stuff online. That alone sounds huge.
It is pretty groundbreaking. Think back to the early internet. We got email over IP, right? SMTP, changed messaging.
Yeah, completely.
Then voice over IP, VoIP, did the same for phone calls. Blockchain is giving us money over IP, or maybe more broadly, value over IP.
Value over IP. I like that. Yeah.
And when we talk about Bitcoin, just remember, Bitcoin is an application. It's like an app on your phone. Right. It's built on top of the blockchain protocol and the underlying infrastructure. It's just one powerful use case, you know, but there could be many others.
That analogy really clicks, makes total sense. So if Bitcoin's just one app, how does it actually work? Like if I want to send Bitcoin to you, what's happening behind the scenes to make it peer-to-peer?
Okay, let's walk through it. From your perspective, the user experience, it's actually surprisingly simple.
Good.
You'd use a digital wallet app. Phone, computer, whatever. You scan the recipient's address, which, yeah, it looks a bit like a long scrambled email address, sort of.
Right, those long strings of characters
Like
you see?
Exactly. You hit send, maybe confirm the amount, and boom, the funds show up in their wallet. Often as quick as sending a text.
Okay, but what's in that wallet? Is it like digital cash?
Ah, good question. Here's a key distinction. Your digital wallet doesn't actually hold the money itself.
It doesn't.
No. What it holds are special digital codes. We call them cryptographic keys.
So the wallet is more like a digital key ring, not a wallet stuffed with bills.
Exactly. A digital key ring is a great analogy. And these keys are just unique digital codes.
Yeah.
You get a public key that's like your address, the one you give out so people can send you stuff.
Okay.
And then you have a private key. That's your secret, like a super secure password.
Gotcha.
When you want to send a transaction, you use your private key to put a unique digital signature on it. It proves it came from you, proves it hasn't been messed with. Okay, that makes sense. So I sign it digitally. What happens then? Does it just zap straight to the other person's wallet?
Not quite directly, no. Once you sign it, that transaction gets broadcast out to this huge global network. It's peer-to-peer, P2P.
Right.
Thousands of independent computers, we call them nodes, all over the world. And each of these nodes keeps an identical, constantly updated copy of the entire transaction history. That's the distributed ledger.
Ledger, okay.
Your transaction first lands in this digital waiting room. It's called the mempool.
Mempool. The memory pool.
Yeah, exactly. And then special participants on the network called miners, they step in.
Ah, miners. And this mining concept, it sounds intense. What does that actually involve? Are they digging digital gold?
Hey, well, it does sound like that, doesn't it? But think of mining as the crucial accounting function for the blockchain.
Mining, okay.
Yeah. The miners grab transactions from that mempool and bundle them together into these batches. We call them blocks.
Yeah.
For Bitcoin, this happens roughly every 10 minutes. Now, to discover a new block or sort of seal it, miners use these specialized computers, super powerful hardware. And these machines are basically guessing numbers incredibly fast. They're making Nonce guesses.
Nonce guesses. What's a nonce?
It's just a number used once, basically. They're trying to find a specific random-looking number that meets the network's requirements.
Billions of guesses a second, you said. Just trying to find one number. That sounds incredibly inefficient. Almost wasteful, doesn't it?
It does. That's a really sharp observation. It is, on the surface, like a massive digital lottery.
Right.
These mining machines, they're churning through billions, literally billions of guesses every single second, trying every possible 32-bit nonce, for instance.
Wow.
Until one machine somewhere in the world randomly guesses the correct number, the magic number that solves the puzzle for that block.
And the winner gets?
The winning machine gets to confirm and record all the transactions in that block. And for their effort, they collect a reward. In Bitcoin's heyday, that reward could be substantial, maybe like $130,000 worth of Bitcoin per block, plus transaction fees.
Okay, that's a serious incentive.
Absolutely. Then all the other nodes on the network quickly double-check the winner's work, confirm the transactions are valid, and they all add that new block to their own copy of the ledger.
But that huge effort,
Yeah.
the guessing, why? What's the point of all that seemingly wasted computation?
But here's the genius of it, or maybe the counterintuitive part. That seemingly wasteful effort, it serves a critical purpose: security.
How so?
It's so expensive, requires so much computing power and electricity to guess that number, that it makes it incredibly difficult and costly for anyone to cheat the system.
So it deters bad actors.
Precisely. It makes trying to rewrite history or spend coins twice prohibitively expensive. That difficulty is the security. And one more thing. Each new block contains a cryptographic link, like a digital fingerprint or hash of the block that came before it.
Okay.
That's how they're literally chained together, block after block after block, forming the blockchain.
It's a blockchain. Okay, clicks.
And this network is tough. Back in, say, early 2018, there were over 11,000 nodes globally, each holding the full Bitcoin history. That's resilience.
Okay, here's where it gets really interesting for me. Beyond the nuts and bolts, the mechanics. What are the fundamental ideas that make blockchain so unique? What are these pillars that let us have this trustless system you mentioned?
Great question. Because, understanding these core concepts is key to seeing why blockchain is, well, different. First up, the ledger itself.
Right, the shared record book.
Exactly. Imagine a massive global digital spreadsheet, like Google Sheets or Excel, but one that everyone can see or at least verify. New records, transactions just get added as new rows.
Appended only.
Right.
Yeah.
Containing info like account balances, maybe who owns what asset. And in more advanced blockchains, this ledger doesn't just hold transaction data. It can hold the memory and even the current running state of computer programs.
Okay, so it's a shared database that only ever grows. You can't delete rows.
That's the idea. Which leads right into the next concept, the distributed network.
Peer-to-peer, like you said.
Yeah. Many equal nodes or peers, all connected. There's no single central server, no single point of failure, no central control.
And the benefit there is?
Security and resiliency. It's built to keep working even if some nodes crash or even if some try to act maliciously. There's a technical term, Byzantine fault tolerance.
Sounds complicated.
It basically means the system can reach agreement and stay secure even if a certain percentage of participants are unreliable or outright hostile.
Okay, impressive. What's next?
Immutability. This one's huge. Once data is written to that ledger, confirmed in a block, it cannot be changed.
Cannot be changed. Like, ever.
Effectively, yes. It's like carving it into digital stone. Everything is auditable. You can trace it all back if you need to correct something.
Yeah. What if there's a mistake?
You don't erase the mistake. You issue a new transaction that offsets or corrects the old one. Both the mistake and the correction are now permanently recorded.
Wow. So, carved in stone. That sounds incredibly secure, but also kind of inflexible.
Yeah.
What if there's a genuine error, or people use it for bad stuff?
Yeah.
Is there really no undo button?
You've hit on a critical tension there. No, there's no traditional undo button. That's what gives it such strong security against tampering and fraud.
Right.
If a mistake happens, the correction is also permanently recorded, providing transparency. As for illicit use, that's where other layers come in regulations. Off-chain enforcement, know your customer rules, which, the blockchain itself doesn't automatically solve. We can touch on that later.
Okay, good point. Keep going with the pillars.
Right. Then there's cryptographic identity. We talked about the keys, right? Public key like an address, private key like a password. You need this cryptographic identity to use the network. It enables true digital account ownership and lets the network trace actions back to specific signed transactions. Accountability, in a way.
Okay. And the last one,
Consensus algorithms. This is crucial. How does this distributed network, all these thousands of nodes, actually agree on the current state of the ledger? How do they agree on which transactions are valid and what the next block should be?
Yeah, how do they all get on the same page?
They need a mechanism, an algorithm to reach consensus. This makes sure everyone's ledger matches, and really importantly, it prevents double spending, someone trying to spend the same digital money twice.
Right, that would break everything.
Absolutely. And there are different ways to achieve this consensus. Bitcoin uses proof of work, or POW. That's the mining thing we discussed. Very secure, but expensive, computationally heavy, not very green.
Yeah, it's like it.
Newer blockchains, like Ethereum now, are using proof of stake, POS. It's generally much more energy efficient. The basic idea there is that users stake their own coins to get a chance to validate transactions rather than using raw computing power.
Interesting. Any others?
Yeah, there are next-gen methods too. Things like Practical Byzantine, fault tolerance, PBFT. Some newer projects use variations of this. Often involves randomly selecting a small, hidden group of users for each block confirmation. Can be very fast and secure.
Okay, that's quite a few technical concepts, but I see how they fit together. The ledger, the network, the immutability, the identity, the consensus.
That's right.
Yeah.
Exactly. If you put it all together, blockchain offers a system that is fundamentally trustless. You trust the math and the protocol, not a central entity. It's distributed or peer-based. It's consensus-driven. Everyone agrees on the state. And it's immutable. The history can't be secretly changed. Those are the core properties.
So let's bring this all together now. We understand the how a bit better, but what's the so what? What actual problem does blockchain solve? Why should we everyday folks, businesses, society really care?
Oh, okay, yeah. The so what question. It really boils down to what I sometimes call the problem with middlemen.
Okay.
Think about physical cash for a second. If I hand you a $10 bill, it's purely peer-to-peer.
Is it just me and you?
No bank involved. You do your own quick fraud detection. Does it look real? Is it ripped? For small amounts, locally, there's enough trust. It's pretty anonymous. And it's distributed. The cash system works because lots of people have cash.
Right, but online.
But most electronic transactions today, they require a third-party intermediary, a bank, a credit card company like Visa or MasterCard, a payment processor like PayPal or Stripe. Someone in the middle.
And let's be fair, these middlemen, they aren't all bad, are they? They provide security, infrastructure, convenience.
Oh, absolutely. For decades, they've been indispensable. They built the infrastructure, they manage complex commercial relationships, they simplify things for us, they handle fraud detection, customer service, dispute resolution.
And regulation.
And crucially, regulatory compliance, things like know your customer, KYC rules, anti-money laundering, AML checks. Until blockchain came along, this complex system of trusted intermediaries was really the only way to reliably send value electronically over distances.
Okay, but there are downsides.
There are significant limitations, yes. Think about merchant fees. Businesses often pay a fixed fee plus somewhere between 1% and 3% on every card transaction.
Ouch.
Settlement is slow. It can take days for the money to actually move and clear between banks. Chargebacks, while protecting consumers, shift fraud risk onto the merchants.
Right.
Doing tiny payments, microtransactions, is often just too expensive because of fixed fees, and sending money internationally. Still, often slow, incredibly costly, and surprisingly prone to errors.
And you mentioned the underbanked earlier.
Exactly. This existing system leaves people out. There are roughly 2 billion people worldwide who are underbanked or unbanked. They don't have easy access to these traditional financial rails.
That's a staggering number.
Okay.
So how does blockchain fundamentally change that equation for them and maybe for the rest of us too?
Well, blockchain-based payment networks, they aim to bring us back to that peer-to-peer model, but for the digital world. This directly tackles several of those problems. Speed. Transactions can often settle in minutes, sometimes seconds, not days. Trustless trust. You rely on the network's cryptography and rules, not faith in a third party. Equipment. You often just need a smartphone, no special terminals. Fraud. Significantly reduced because of that immutable, transparent ledger.
And costs.
Costs can be minimal, often just fractions of a cent per transaction, making microtransactions viable. Chargebacks, they don't exist in the same way. Transactions are generally final, which shifts risk but simplifies things for merchants. Fees, often no monthly fees just to hold an account. Transparency. Transactions are typically public on the ledger, though the identity behind an address isn't necessarily known.
This trustless trust idea,
Yeah.
It seems really fundamental. It's not just about making payments faster or cheaper, is it?
Not at all. It's a paradigm shift. Imagine reducing our reliance on these massive centralized institutions just to verify every single exchange of value. Think about the potential that unlocks, especially for those 2 billion underbanked suddenly. They might be able to participate directly in the global digital economy without needing a traditional bank account or credit history. That's potentially revolutionary.
It really does sound almost utopian in some ways. This frictionless, peer-to-peer digital value transfer. But surely there has to be a catch. You alluded to it earlier. What are the big challenges or criticisms? What does blockchain not solve, at least not yet?
Yeah, that's a super important reality check. Blockchain is a powerful tool, a foundational layer, but it's not a magic wand. It doesn't automatically fix everything the old system handled.
Like what?
Well, for instance, it doesn't inherently police bad actors in the real world. Someone can still use it for illicit purposes. It doesn't automatically handle those KYC/AML compliance checks that regulators demand. Those often need to be built as layers on top or handled off-chain.
Right, the regulation piece.
Exactly. It doesn't inherently provide insurance if you lose your private keys. If you lose your keys, you lose your coins, usually. There's no built-in customer service hotline to call if something goes wrong. It doesn't replicate the complex commercial relationships and credit lines that banks facilitate.
Okay.
And there's still significant technical complexity for the average user, though it's getting better. Regulatory uncertainty is still a huge factor globally. And for many people, there's the simple, practical hurdle of how do you even get cryptocurrency in the first place? How do you bridge that gap from traditional money?
So lots of hurdles still.
Definitely. These are all major challenges the ecosystem is actively working on, but they show the technology, while powerful, is still maturing. It needs layers built around it.
That paints a clearer picture. It's a foundational shift, but with significant growing pains. So how fast is this actually catching on in the real world beyond just the crypto enthusiasts?
It's actually moving incredibly fast, maybe one of the fastest technology adoptions we've seen in certain sectors. There was a Juniper Research survey back in mid-2017, I think. Yeah. It found that 57%, over half of large corporations, we're talking companies with over 20,000 employees, were either actively considering or already in the process of deploying blockchain solutions.
Wow, 57% back then.
Yeah. And 2/3 of those surveyed expected to have blockchain integrated into their systems by the end of 2018. Now, adoption timelines always shift, but the direction was clear. And IDC, another market research firm, estimated global spending on blockchain would hit something like $2.1 billion in 2018 alone. That's serious investment building up quickly.
That is a rapid climb. So the comparison seems apt. Is this really like the early days of the internet all over again, but focused on value instead of just information?
I think there are incredibly strong parallels, yes. Many people are calling blockchain tech the foundation for the Internet of Value.
Right, you mentioned that earlier.
It's seen as this new platform that could fundamentally reshape business, commerce, how we exchange anything of worth, really. It breaks down geographical barriers, uses math and cryptography for trust, aiming to cut out fraud and unnecessary intermediaries.
Just like the early web aimed to cut out intermediaries for information.
Precisely. And you see the same patterns as the internet in the 90s. Huge investment buzz, incredible excitement, maybe some hype.
Definitely some hype.
Definitely some hype. Visions of countless potential uses, some realistic, some maybe less so. And we expect a similar, though maybe even faster, adoption curve and path to maturity.
And where are we seeing the first wave of applications really take hold? Is it all just finance?
Finance first is definitely a major theme. That makes sense, right?
Yeah.
It's what Bitcoin, the first major application, was built for. It's where the money is, literally. And it's where the pain points with existing middlemen are often most acutely felt. So payments, remittances, trading, settlement lots happening there.
But not only finance.
Not at all. We're
Okay.
seeing specialized blockchains or blockchain applications emerge in all sorts of areas. Things like secure digital background checks, supply chain management, tracking goods from farm to table, ensuring authenticity.
Oh, interesting.
Creating tamper-proof digital records for things like property deeds or car titles, even in healthcare potentially for managing electronic medical records securely, or facilitating sensitive genome research data sharing.
Wow.
Airlines are looking at it for things like loyalty programs or streamlining rebooking during disruptions, and we're even seeing these little tokenized economies pop up, like imagine a tech co-working space where a digital token represents, say, 1 hour of desk usage.
That's fascinating. It really touches potentially everything.
Uh-huh.
Okay, so the adoption parallels the early internet. And just like the internet boom, the financial side, the investment angle is huge. Let's dig into that. What does this Internet of Value look like in terms of actual investment and market development?
The investment has been really significant. And what's particularly striking isn't just the total dollars, but who is putting money in.
Like the names.
Exactly. The names signal mainstream interest. You had people like Reid Hoffman, co-founder of LinkedIn, investing $20 million in Blockstream, a core Bitcoin tech company. Sir Richard Branson backing BitPay, a payment processor, with $30 million.
Wow.
Goldman Sachs leading a $50 million round for Circle, another major crypto finance company. Even the New York Stock Exchange led a $75 million investment in Coinbase, the big exchange.
Okay, those are definitely heavy hitters. Not just niche players.
Not at all. The point isn't just the numbers, which are big, but the fact that these major influential figures and established financial institutions are validating the space with serious capital.
So what does that signal, do you think? About the maturity or perceived potential?
I think it signals a growing confidence institutionally that this technology isn't just a flash in the pan. It shows that serious money and serious minds see genuine long-term potential for disruption, for innovation, for new markets.
That leads to?
Well, it leads to the emergence of what people are calling a whole new asset class. The cryptographic asset class.
Right. Crypto assets, coins, tokens.
Exactly. And initial coin offerings, ICOs, saw this absolutely explosive growth period. By late 2017, cumulative ICO funding had reached something like $3.5 billion.
$3.5 billion.
Yeah. And in some months during that period, ICO funding actually surpassed traditional venture capital funding for early stage tech.
That's wild.
It was wild. Now, these tokens issued in ICOs, they're not always just about raising money like stocks. They can have all sorts of functions built in, like granting voting rights and how a project develops, entitling holders to a share of future revenue or dividends, providing access to a specific service, or enabling participation within a platform's economy.
So they're more functional than just shares sometimes.
It can be, yeah. Programmable value, in a sense.
And how are the world's regulators trying to deal with this explosion of new assets and funding models? Must be complex.
Oh, hugely complex. And the approach is vary massively across the globe, which, adds another layer of uncertainty.
Right.
In the U.S., the Securities and Exchange Commission, the SEC, has largely focused on investor protection. They use existing frameworks, like the Howey test from the 1940s, to determine if a specific ICO token should be considered a security.
Like a stock.
Essentially, yes. And if it is, then it falls under all the strict securities regulations. Singapore's monetary authority took a similar view, saying ICOs may be securities depending on their structure.
Okay. What about elsewhere?
The UK, for a while, had more of a caveat emptor or buyer beware stance, putting more responsibility on the investor to understand the risks. China took a very different, very strong approach. In September 2017, they outright banned ICOs and ordered domestic crypto exchanges to close down.
Wow, a complete ban.
Yeah. And Russia was working on its own regulations around that time, too. So it's really a patchwork quilt globally, and it's still evolving.
Definitely sounds like a moving target. So with all this activity, how big did this whole crypto market actually get? Put it in perspective for us.
Sure. So around early 2018, the total market capitalization of all cryptographic assets combined was hovering somewhere around, say, $481 billion.
Okay, $500 billion roughly. That sounds big.
It does sound big in isolation, but compare it to, say, the total value of the S&P 500 stock index at the time, which was over $22 trillion.
Okay, yeah.
That's in perspective.
Or U.S. GDP around $19 trillion. So crypto was, and still is, relatively small compared to major traditional markets, but its growth rate was, and potentially still is, phenomenal.
And are the big institutions, the traditional players, actually trading this stuff yet? Or just investing in the companies?
We started seeing real institutional interest and demand for ways to get involved directly, but in a regulated way. Things like dark pools started emerging.
Dark pools? Sounds mysterious.
Hey, it just means private trading venues off the public exchanges. They're often used by institutions to execute very large trades without immediately impacting the public market price. And perhaps more significantly, major regulated exchanges like the CBOE and CME launched Bitcoin futures contracts in December 2017.
Futures contracts, like for oil or gold?
Exactly like that.
Okay.
It was a huge step because it provided a regulated, familiar way for mainstream institutional investors to get exposure to Bitcoin's price movements without having to hold the actual Bitcoin itself. It signaled a real bridging into traditional finance. And this idea of asset tokenization, you mentioned it briefly. How does that fit into this bigger financial picture? It sounds like you could tokenize, well, almost anything.
That's the potential, yes. Asset tokenization is basically the process of taking almost any asset, whether it's a real-world thing like a piece of real estate or art, a share in a private company, like future royalty payments, or even a purely digital good and representing ownership of it as a digital token on a blockchain.
Okay.
These tokens can then, in theory, be easily traded, divided into smaller fractions, or programmed with specific rules, all within a blockchain ecosystem. Imagine owning a tiny fraction of a commercial building represented by a token.
Right. That could make illiquid assets much more liquid.
That's one of the big promises. It could lead towards what some call the token internet, a future where many different forms of value are represented as tokens, allowing users to participate directly in various digital economies, own fractional shares of things, and interact in entirely new ways that go far beyond just sending simple payments.
We've really covered the massive impact blockchain is starting to have, how it's shaking things up. But to really get how it works, how it delivers on these promises, maybe we should pull back the curtain a bit more. Look at the core technical building blocks under the hood.
Absolutely. I think understanding a few key technical components helps solidify the concepts.
Yeah.
Let's touch on some fundamental building blocks.
Okay.
First, just some basic terminology we've used. An address, remember, is like that public account number. A transaction is just the record of value being transferred. A block is that batch of confirmed transactions. And the blockchain is the whole sequence, the chain of blocks. And a wallet is the software managing your keys and addresses.
Got it. Basics covered.
Then, super important, hashing functions. Think of these as digital fingerprint machines.
Okay.
They take any input data, could be a tiny text file, could be a massive movie, and they produce a fixed size output string. Always the same length. Bitcoin uses SHA-256, which gives you a 256-bit hash, usually shown as 64 hexadecimal characters.
And the key thing is?
A few key properties. One, even a tiny change in the input data, like changing one letter in a book, results in a completely different hash output. Two, the same input data will always produce the exact same hash output. Three, they are one-way functions. It's practically impossible to take the hash output and figure out what the original input data was.
So you can't reverse it. What are they used for?
Lots of things. Securely storing passwords, you store the hash of the password, not the password itself. Verifying data integrity, if you hash a file and the hash matches later, you know it hasn't been tampered with. And in blockchain, proving that computations were done correctly, like in mining.
Okay, hashing is key. What else?
Merkle trees. This sounds complex, but it's basically a clever way to hash lots of things together efficiently. It's like a hash of hashes.
Hash of hashes.
Yeah. Imagine you have a block with thousands of transactions. Instead of hashing them all individually, you hash pairs of transactions, then you hash pairs of those hashes, and keep going up like branches on a tree until you get a single final hash at the top, the Merkle root.
And the benefit?
It allows the network to very quickly verify if a specific transaction is included in that block, or to detect if even one small piece of data within that large block has been changed without having to re-download and check the entire block. Very efficient for verification.
Clever.
Then there are encoding schemes. Just a small point, but useful. Bitcoin addresses, for instance, use something called base 58 encoding.
Base 58. Why not base 64 like we see elsewhere?
It's designed for humans. Base 58 deliberately leaves out characters that look similar and can be easily confused when reading or typing them out, like the number 0 and the capital letter O, or the capital I and the lowercase l. Just makes addresses slightly easier and safer to handle manually.
Ah, practical. Makes sense.
And we've hit this a few times, but it's fundamental. Public-private key cryptography. That pair of unique, mathematically linked keys.
Public for receiving, private for sending, signing.
Exactly. Data encrypted with one key can only be decrypted by the other key in the pair. The primary goal here, in traditional cryptography, is usually confidentiality, making sure only the intended recipient can read a message.
Okay. And related to that?
Digital signatures. These use the same public-private key pair, but for a different goal. When you sign a transaction with your private key, it allows anyone with your public key to verify three things. One, that the transaction definitely came from the owner of that private key, authentication. Two, that the transaction hasn't been altered or tampered with since it was signed, integrity. And three, the signer cannot later deny having signed it, non-repudiation. The main aim here is confidence in identity and data integrity rather than secrecy.
So keys for secrecy, signatures for authenticity and integrity. Got it. That covers a lot of the core tech pieces. Now, for people who actually want to build on this or maybe just interact with blockchain data more directly, what are the practical options? How do they actually talk to the blockchain?
Right, getting practical. If you're a developer or just technically curious, you generally need to do a couple of things. Either you need to access existing blockchain data, look up blocks, check transaction details, see balances, and maybe send new transactions onto the network.
Okay, reading and writing data.
Pretty much. Or you might need to perform some of the core cryptocurrency functions yourself, like generating new key pairs, hashing data correctly, or constructing and signing transactions offline before broadcasting them.
And how do you actually do that? What are the main approaches?
You've basically got two main options, with pros and cons for each. Option 1, run your own node.
Like download the whole blockchain history yourself.
Exactly. You run the full client software for Bitcoin or Ethereum or whatever blockchain you're interested in. The big advantage, complete independence. You're not relying on any third-party service. You have direct access to the raw data. You can validate everything yourself.
Sounds ideal. What's the catch?
The downsides are significant. It requires a lot of disk space, hundreds of gigabytes, sometimes terabytes, and growing. It needs to be constantly running and synchronized with the network. You're responsible for its uptime, security, maintenance. And a basic node often won't easily give you historical balances for addresses you don't control or other enriched data you'd have to build that indexing yourself.
Okay, so powerful but demanding. What's option 2?
Option 2 is to use an API, an application programming interface. There are quite a few companies now that run nodes themselves, index all the data, and provide easy-to-use APIs that let you query the blockchain and submit transactions without running your own infrastructure.
Ah, so you rely on their service.
Exactly. The pros are convenience, scalability, and they often provide much richer data like tracking balances for any address, getting transaction metadata, maybe offering notifications or more advanced functions like multi-signature transaction support.
And the cons?
The main con is that you are relying on an external third-party service. You introduce an external dependency into your application. You need to trust their data and their uptime. And for sensitive operations, especially anything involving handling private keys, it's generally strongly recommended not to build complex crypto functions like key generation or signing from scratch yourself, or rely solely on a remote API for signing. It's better to use well-vetted open source libraries and frameworks locally for those critical parts.
So it sounds like it's not necessarily an either choice between running a node and using an API.
Not at all. In fact, a hybrid approach is often very practical.
How so?
You might run your own node on a test network or even mainnet for development, experimentation, maybe simulating users or deep diving into raw data. But for your actual production application, your server, your main scripts, you might rely on a robust, reliable API service for querying data and broadcasting transactions. You get the best of both worlds: control and deep access for development, scalability, and convenience for production.
That makes a lot of sense. Wow. What an incredible journey this has been. We've gone from a basic definition of blockchain through how things like Bitcoin work, the core concepts, the problems it solves, the adoption, the economics, and even right down to the technical building blocks and how to interact with it. It really feels like we are standing at the edge of something truly transformative, something that could fundamentally reshape how value moves around the globe.
I think we are. And it leads to a fascinating thought, doesn't it? If blockchain truly offers us this internet of value, if it starts addressing some of those deep limitations in our current financial systems, what other fundamental societal structures, beyond just finance, might it begin to revolutionize next? Especially when you consider that potential to empower those 2 billion underbanked people worldwide, giving them direct access to a global, transparent economic system. It really makes you wonder, what else changes when trust can be based on mathematics and code, rather than just institutions? It's definitely something to ponder.
That is a fantastic, provocative thought to leave us with. Thank you so much for walking us through all of that, and thank you all for joining us on this deep dive. We'll see you next time.